Today, we're opening a case file on a hidden financial danger for pretty much any student out there. We're calling it the scholarship tax trap. We're going to investigate how free money can suddenly trigger a surprise tax bill, a bill that many students simply can't afford to pay.
So let's just get right to the heart of it. That scholarship you worked so hard to get, is it actually free? Well, the answer, which is buried deep inside the tax code, is often a shocking no. And that's exactly where our case begins.
Okay, so let's imagine a student. We'll call her Sarah. She gets this amazing $20,000 scholarship that covers her tuition, her fees, and even her dorm. Naturally, she thinks, great, it's all tax-free. But then tax season rolls around and bam, she gets hit with a $1,200 tax bill. The problem? That money's already been spent, and now she's facing what's called a liquidity crisis. So, how on earth did this happen? To get to the bottom of this, we're going to follow a clear investigative path. First, we'll look at the law itself, the thing that creates this trap. Then, we'll uncover some of the hidden hazards in the system that make it so easy to fall in. After that, we'll look at the financial fallout. And finally, we'll figure out how to build a defense so this doesn't happen to you. Let's dig in. All right, our investigation starts inside the United States tax code, which creates what our sources call a split reality for scholarship money. And honestly, it's a reality that looks super simple on the surface, but is actually dangerously complex right underneath. So the first clue is buried in the Internal Revenue Code, specifically Section 117. The law says scholarship money is tax-free only if it's used for qualified tuition and related expenses. Now, what does that mean? It means your tuition, mandatory fees, and any books or supplies that are required for your courses. But I want you to pay very close attention to what's not on that list. And here it is. This slide shows the trap perfectly. Any money you use for tuition and required stuff, tax-free, no problem. But the portion of that very same scholarship check that you use for room and board, travel, or other living expenses, the IRS sees that as taxable income. Think about that for a second. It's the same scholarship, but the law literally splits it in two, creating a tax bill on the money students need just to live. Okay. Now let's see how this legal theory turns into a real-world nightmare. Because it's not just the law. The very tools we use to file our taxes can lead us straight into this trap. We're now moving into the territory of hidden operational hazards. And this quote is a key piece of evidence. You know all that popular tax software? It's designed to be simple, which is usually a good thing. But here, that simplicity is the problem. The software often just doesn't ask the right questions. It doesn't prompt students to break down how they spent their scholarship money. So they end up reporting the whole thing as tax-free, and they have no idea they've made a mistake. And even the official forms don't help. This right here is the IRS Form 1098-T. It's what schools send out, and it reports scholarships you got and tuition you were billed for. But look closely. Notice what's missing. There is no separate box for room and board. This design flaw makes it incredibly difficult for a student, or anyone really, to figure out what part of their scholarship is actually taxable income. And the result of all this confusion? A pretty staggering number. Sources suggest that up to 90% of students filing taxes can be caught completely off guard by these software and reporting blind spots. This isn't just a few people making a mistake. It's a systemic issue that trips up the vast majority of students, many of whom are filing taxes for the very first time. And get this, there's an invisible force making this trap even worse every single year. Inflation. I mean, as the cost of housing and food just skyrockets, a bigger and bigger chunk of that scholarship money has to go towards covering these taxable living expenses. The law's definitions, though, they stay the same. So the tax trap just silently grows larger and more dangerous each year. So what happens when the trap finally springs? Well, the consequences can be really severe. Let's take a look at the financial fallout for the students who get caught. And this brings us right back to that liquidity crisis. This is the core danger. A student gets a tax bill for, say, thousands of dollars, based on scholarship money they spent months ago on essential things like a place to live and food to eat. They have the tax liability, but the cash, it's long gone. And, you know, a crisis like this often doesn't go unnoticed. The IRS has automated systems that are constantly looking for red flags. Things like a mismatch between your return and that 1098-T form, or reporting a big scholarship with zero taxable income. Those can trigger an audit and pretty scary official notices demanding payment. And if you do underpay, the penalties are no joke. The IRS charges interest on any unpaid taxes. As of right now, it's sitting at 7%. And that rate can change. The debt grows fast, and it can turn a simple, honest mistake into a really significant financial burden. Okay, so now that we've really laid out the crime scene, let's pivot to the solution. How do you actually avoid this trap? It is time to build your asset defense strategy. This slide really lays out the two different paths you can take. On one side, you have Sarah, our first student. She was unaware. She didn't know the rules, and now she's in a crisis. But on the other side, we have Emily, the architect. She takes a totally different approach. She actually looks up IRS Publication 970. That's the official rulebook. She tracks all of her expenses, and she plans ahead. She goes from being a potential victim to someone who is empowered, defending her own assets. So what does a good defense actually look like? Well, it really comes down to 4 key protocols. First, meticulous record keeping. You've got to track where every single scholarship dollar goes. Second, proactive planning. Figure out your potential tax bill before you even spend the money. Third, strategic allocation. If you can, use your scholarship money for those qualified tax-free expenses first. And finally, number 4, when in doubt, consult an expert. Talk to a CPA or a tax professional. Now, for those who want a more advanced strategy, check this out. That same IRS Publication 970 allows for a pretty fascinating move. You can sometimes choose to report a normally tax-free grant, like a Pell Grant, as taxable income. Now, why in the world would you do that? Well, because doing so can free up more of your tuition payments to make you eligible for some really powerful education credits, like the American Opportunity Tax Credit. It's a trade-off, right? You have to do the math and see if the money you save from the credit is more than the small amount of tax you'll pay on the grant. It's really about playing chess with the tax code, not checkers. So here's the bottom line, the crucial point of this whole investigation. Your mission is to shift from being just a passive recipient of financial aid to being an active financial manager. You need to review the terms of your aid, track your spending with forensic-level detail, and plan for your taxes before they become a crisis. And that leaves us with one final big-picture question. In an era where college costs are just exploding and scholarships are an absolute lifeline for so many, is a tax code this complicated creating a needless and unfair trap for the very students these programs were designed to help in the first place? It's definitely a question we're thinking about.